In a small service business, 4 different numbers can all be described as what I made this year. These numbers can sit tens of thousands of dollars apart. The first is revenue, which is everything customers paid you, totaling $90,000. The second is gross profit, calculated as revenue minus the direct costs of doing the work, such as materials, supplies, subcontractors, and fuel, amounting to $22,000. The third is net profit, which is gross profit minus overhead expenses like insurance, vehicle costs, phone bills, software, licenses, advertising, accounting, and equipment replacement, totaling $12,000. Finally, what you actually keep is net profit minus taxes, including self-employment tax of roughly 14% and income taxes, leaving you with around $42,000. While revenue might be $90,000, what you actually keep could be as low as $42,000. Both numbers are true, but only what you keep pays your mortgage. This discrepancy highlights the importance of understanding each financial figure in your business. Confusion between these numbers can be costly. It corrupts pricing, leading to underpricing because the real figure is lower than expected. For example, saying, I made $90,000 on 400 jobs, so I'm getting $225 a job, leads directly to underpricing, as the real figure is closer to $105. It makes growth look like progress, as revenue can increase while margins decrease, meaning more work for less money. This is extremely common and nearly invisible if revenue is the only number you watch. It hides the real problem, as 2 businesses with the same revenue can have vastly different profits. Finally, it makes April a shock if you treat deposits as income and spend money that should cover taxes. The key number to watch is net profit, observed monthly. This figure governs your business decisions, as it answers the question, is this worth doing? While gross profit and revenue have their uses, net profit is the only number that truly reflects the business's value. Gross profit tells you whether your pricing covers the work, and revenue tells you about demand, but net profit answers whether the business is worth the effort. Knowing your net profit as a percentage, not just a dollar figure, is crucial for comparing different periods of business performance. Understanding your margin is crucial. Net profit divided by revenue gives you your margin, which allows you to compare performance across different years. A business that earned $90,000 at a 62% margin did better than one that earned $130,000 at 41% on every measure that matters except bragging rights. Watching the margin over time can reveal whether costs are growing faster than the work, indicating issues like a route getting looser, prices that have not moved, or scope that has quietly grown. Watch your margin over time. If your margin drifts down while revenue climbs, it indicates that costs are growing faster than the work. This could be due to a route getting looser, prices that have not moved, or scope that has quietly grown. Monitoring your margin helps identify these issues early, allowing you to make necessary adjustments before they impact your overall profitability. 2 common mistakes can make your numbers lie. First, not paying yourself a defined amount results in a business that appears wildly profitable on paper but is actually subsidized by unpaid work. If you take money out whenever the account looks healthy, your business has no labor cost and its profit is fiction. Pay yourself a set amount on a schedule. Then, net profit is the profit after your wage, which is the only version that tells you whether the business earns anything beyond employing you. Second, ignoring equipment replacement can make a year with no replacement look more profitable than it is. The mower, the vacuum, the truck, they wear out on a schedule and get replaced in a lump. Set aside a monthly amount so the cost lands where it was earned. The foundation of accurate financial understanding is logging income and expenses as they happen, in one place and in the same motion as the transaction. This habit allows you to answer 3 key questions quickly. What have I earned so far? What have I spent, and on what? What is the profit, and what is the margin? If these questions take an afternoon of receipt archaeology, you will not ask them, and you will find out in April when nothing can be changed. If they fall out of a log you already keep, you ask monthly without effort, and a bad margin found in November is a problem you can still fix. Avoiding surprises in April involves maintaining accurate records throughout the year. If your financial data falls out of a log you already keep, you can review it monthly without effort. Discovering a bad margin in November is a problem you can still fix, unlike finding out in April when nothing can be changed. This proactive approach allows you to make adjustments and improve your financial situation before it's too late. Remember, revenue reflects what the market thinks of your marketing efforts, while profit shows what the market thinks of your business. You can increase revenue by cutting prices, but only profit pays you. This distinction is crucial for making informed decisions about your business strategy and ensuring long-term success. For more insights and tools to help you manage your business finances, visit weaverbusinessacademy.com.